slide 62, the latest ISM manufacturing PMI data seems to think we could be heading towards an inventory-led recession. That's your run-of-the-mill, stereotypical goods correction, inventory cycle correction. This is how those are the boring recessions. The less boring recessions, the financial crises type recessions, the asset bubble bursting type recessions, those are the ones you got to be scared of. And right now, at least according to the BIS data, that we showed in our leverage cycle analysis, we're not quite there yet. But again, we still need to get more data. That data comes out on a decent lag. But what I'm showing here in this chart is just kind of the spread between new orders and inventories that went negative. And as you can see in this chart, typically when you go negative, it's ahead of a red bar. There's only been, kind of a handful of noteworthy exceptions. You kind of get to negative, you don't get a red bar. So again, betting on the betting on the lower probability is a dumber idea than betting on the high probability. Although there's nothing certain about the future, so we'll at least be humble enough to admit that. On slide 63. Trucking rates will provide a real time signal throughout an investigative process. Again, we're way too far from actually observing below trend growth data to actually say whether or not we're going to get a recession. Right now, we're just looking at leading indicators like the yield curve that might suggest we could get a recession, but we're not quite there yet in terms of being able to assess that. Typically, what happens in recessions is the economy is already in a cyclical deceleration. Leading indicators, low incident indicators, lagging indicators, or maybe not lagging indicators, but certainly leading to coincident indicators, are already telling you you're at a cyclical deceleration to a below trend growth state, to a below potential growth state. And then boom, some shock happens. Policy tightening, geopolitical risk, something, it could be anything. Anything can happen. It's just it just happens when you're vulnerable. And so we have to assess where we will be kind of towards the end of this deceleration process. If you talk about getting into kind of early Q1 of next year, or not early Q1, but just getting into Q1 of next year in terms of where our projection period can extend us to, is saying we'll still be decelerating at that particular juncture. So kind of Q4, Q1 of next year, I think we'll have enough data on hand to start to really assess whether or not there's a recession coming kind of in mid 2023. But again, I don't think you need to answer that question. Who cares about a recession? What we care about is a minus 2 sigma delta growth slowdown, because that's where all the market risk occurs. It's not whether or not the NBER tells you after the fact we're in recession. Who cares?